using dividends to buy growth stocks. Seems like a simple idea, right? Buy income producing assets, but instead of reinvesting that back into the same assets, take that income and do something like buy growth stocks. Is that a good and effective strategy? I see people ask me this question all the time, so today we're going to be addressing the math behind this. But first, we're going to begin with the more pressing news of the moment, which is the debt ceiling bill, which has to pass in less than 4 days. Otherwise, the US government, first time in history, is going to default and cause a global financial crisis. The bill just did pass the House of Representatives with 304 yeas and 117 nays. That's actually a bit more support than was originally theorized for this bill, and it seems like the center of both parties are mostly on board with this agreement, and both extremes of the party seem to be the main source of opposition. And to be honest, that's kind of refreshing. I don't remember the last time a true bipartisan down the middle bill like this was ever voted on. So the next step is for this bill to arrive on the Senate floor and for it to be voted on. Right now, both Chuck Schumer and Mitch McConnell are backing and supporting this bill. And based off of the House votes, this should pass with the majority of the moderates voting for it. And if that happens, then it goes to the president's desk, and he has already indicated he will sign it. So once this debt ceiling crisis is behind us, I think we're going to pivot back to what we were concerned about before this debate, which is inflation, interest rates, and the coming recession that everybody has been predicting for a long time now is always 6 months away. One piece of data we're watching very closely in relation to this is employment and payrolls. After all, the main objective of raising interest rates is to deliberately slow down the economy to combat rising inflation, and employment is a major indicator of the progress in this field. And this latest report indicates that private payrolls rose 278,000 in May, well ahead of expectations. The expectation was actually just 180,000 for the month. Some notable bits of information here is that the report noted that the distribution of job gains was fragmented, so it wasn't systemic throughout the entire economy. Increases were concentrated in leisure hospitality, which added 208,000 positions. It seems like natural resources and mining was another strong field, as well as construction, adding 64,000 jobs. And some categories did see a decline. Manufacturing is one of those, although you can argue that manufacturing for the long term has been seeing a steady decline. But we also have financial activities losing 35,000 and education and health 29,000. This was really fascinating. So in terms of company size, those with 500 or more workers saw a loss of 106,000 jobs, and small firms with less than 50 workers had huge gains. So the employment side of the US economy is still remarkably strong and resilient. The current unemployment rate is 3.4%. It's hardly budged in response to the massive and very fast pace of rate hikes the Fed has been implementing over this past almost a year at this point. Now, this could indicate that the Fed has more work to do. They have to raise rates even more beyond the current 5 to 5.25% it's sitting at right now. And the current probability for a rate hike in the next June 14th meeting is 30.8%. That would indicate another rise of 25 basis points, bringing us to a rate of 5.25 to 5.5%. So the overwhelming probability right now is that they were not going to be raising rates, but I have been seeing this probability balance shifting in the favor of a rate hike over the past couple weeks, and we're still 2 weeks away from the actual meeting, so anything's possible. And quickly going back to the debt ceiling, this bill might actually have a positive impact on slowing inflation because of this bit of the debt ceiling bill. So if the bill passes, they're going to be ending the freeze on student loan payments this August. You guys might remember that during the COVID pandemic, the government paused all payments on student loans in order to help the economy. And I think in hindsight, it worked a little bit too well. But now we have the reversal of this program, which could have the opposite effect. So the average student loan payment by degree, let's use a bachelor's as the average, is $448 per month. That is what's going to be resuming in August, taking nearly $450 per month out of the pockets of the primary spenders of the economy, the younger age group. So come August, a huge portion of the spending population is going to have $450 less per month to spend in the economy, which I think will have a noticeable effect on inflation. So that's just another factor moving down the pipeline that we're going to see impact the economy in a few months. Okay, now moving on, we're going to mathematically discover if using dividends to buy growth stocks is a good investing thesis. The guy says here that the goal would be to minimize capital erosion, grow your cash flow faster, and still get the benefit of growth investing. So there's a couple of ways to approach this question, and I think I'm going to split it in half. The first half is the debate between dividend and growth investing. Like, which one has better returns? Is one always better than the other? Based off the research I've seen, disclaimer, always do your own research, but it seems like when you look at a long enough time frame that encompasses multiple economic cycles, not just the current bull market, the difference between quality dividend and quality growth isn't that big. From 2006 to now, I think growth outperformed dividend by 1 percentage point. And even that 1% isn't free. You have to contend with a lot more volatility. And if at any point you make a mistake, you sell when things go down, that benefit is then completely lost. So yeah, in my opinion, dividend and growth investing both are fantastic options. And then the other half of this question, he's really asking about timing the market, right? You could always just buy a healthy mix of dividends and growth stocks from day one. But the question here is to first buy dividends and then use that income to buy growth. And I think all you guys watching this know the answer. Timing the market has very few benefits. And we can prove this by looking at the data. So we're going to be using Portfolio Visualizer to do the backtesting. The dividend side of the portfolio is represented by SCHD. We're going to have an initial deposit of $10,000, and we're not going to be reinvesting the dividends. The time frame is 2012 to the modern day. I would have liked it to go back further. Unfortunately, we can't. And in this scenario, SCHD would have grown that initial balance to $26,500. And this is your annual income. And the average payment is about $550. So step 2 is taking that $550 and investing that every year into a growth ETF represented here by VOOG. Again, over that same period of time, the final balance here would be $15,000. So adding up the two balances, $26,500 plus $15,000 gives us a final return or balance of $41,500. To properly judge that return, we have to benchmark it against the S&P 500. So this represents taking that initial $10,000, putting it in VOO, reinvesting the dividends over the same time period, giving us a final balance of $41,400. Almost exactly the same. So this proves those 2 points. Point 1 is that dividend assets, growth assets, over long periods of time, they can both be a great source of return. And the other point of timing the market using dividends to then buy growth has no real advantage. If you want to have a good mixture of dividends and growth, you should do that from day one. And to illustrate that, we can put in a portfolio of 50% SCHD and 50% VOOG. So a split of these two ETFs from day one, reinvesting the dividends, would have given you, again, very similar returns. So that's going to do it for the video. If you guys enjoyed, leave a like, subscribe, and I'll see you guys in the next one.